Thank you. Good afternoon, everyone. On behalf of 4S Services, I welcome all the participants to the Apar Industries Q4 and FY19 earnings conference call. Today on the conference, we have Mr. Kushal Desai, Chairman and Managing Director, and Mr. V.C. Divakar, CFO, Apar Industries. I would now like to hand over the call to Mr. Desai for his opening remarks. Over to you, sir.
Good afternoon, everyone, and a very warm welcome to our Q4 FY19 and annual results earning call. I would like to begin with actually running through a few industry highlights and then follow that up with more financial information and segmental performance. And then post that, we can open the floor to questions. In the year gone by, Apar has delivered a fairly strong consolidated revenue growth of 37% in FY19 to take the overall revenues for the company for the first time to well over $1 billion in a year. All three business segments, which is conductors, oil and cables, witnessed good volume growth with an increasing share of products that we introduced in the last few years getting established. I would like to cover a few highlights in the transmission and development sector and give a little bit of a segmental update for that sector. So the T&D orders of about 45,000 crores are announced by various utilities and key companies in FY19. Overall, there has been reasonably good progress given that the 13th plan with respect to transmission line capacity addition is reaching almost 4 lakh circuit kilometers, and AC substation capacity is reaching almost 8.8 lakh MVA. 100% villages have been electrified, and 100% households electrification has been achieved in 29 states as stated by the government under the DDU-VGY scheme and the Saubhagya scheme. In terms of the DISCOM reform, Uday had achieved a reduction in the book losses of the participating 32 states to about 15,080 crores in the first half of FY19 from a figure of about 51,500 crores in FY16. So it's about 30,000 for the full year, which is a 40% reduction in the losses. The AT&C losses have come in at around 18.3% compared to 20.7% in the previous period. However, this is above the March 19 deadline for the loss reduction, which was supposed to come below 15%. And this has mainly been due to factors like inadequate tariff hikes, rising and outstanding dues from the state governments, and also very low penetration of smart metering. Our expectation is that smart metering will become a critical scheme in the new announcements that the government is going to come up with. In the interim budget FY20, there was a 8.5% higher amount allocated to the distribution sector, with a special focus on creating green transmission corridors for evacuation of power from the non-conventional energy sources of solar and wind, and also projects on certain system strengthening of the grid. The railway electrification has been moving at a fairly rapid pace. The Indian Railways had published 21 high-value tenders of 100 crores and above for electric works, totaling about 4,700 crores in the year. And this is compared to 12 such tenders totaling about 1,700 crores in the previous year. In terms of power grid, they have executed about 18,200 crores of capex in 9 months versus a targeted annual capex of about 25,000 crores. Having said that, we have seen that the industry has been hit in the short term by a few factors. The budgets that had been allocated to the various electrification schemes, which is the Deen Dayal and the Saubhagya scheme, as well as the IPDS, have formally ended. And so as a consequence, disbursements to vendors of various schemes started slowing down considerably from February 2019 onwards. resulting in a fairly large amount of unpaid dues to certain vendors and resulting in a weaker pipeline, especially in the distribution sector as an order opening for FY20. There were many tenders that either did not open or which were opened were not awarded due to the announcement of the national elections under the Model Code of Conduct, which has also delayed ordering for at least 2 months. Credit availability still remains a major issue, and it's really now starting to hurt sales and collections as many companies are hitting maximum exposure limits. So this is having an impact on the business volumes and profitabilities, and we expect that the first half will see the collateral damage taking place from some of these. However, by the end of the second quarter, our expectation is that business flow will be back in a fairly strong growth mode. And our premise is that, the re-elected government augurs actually very well for the sector. We expect increased momentum in the infrastructure spending, especially in the T&D area. The government is already considering Uday 2.0 with a focus on reduction of AT&C losses. It targets all meters to be prepaid smart meters by 2022. It is considering almost 37,000 crores to fund new overhead electricity distribution cabling infrastructure for preventing of power theft. In terms of renewables, power evacuation, as I mentioned, is a challenge, and a new renewable energy grid has been planned. A total allocation is being considered of approximately $5 billion on transmission line tenders in phases beginning from June to route approximately 175 gigawatts of power from the renewable sources in the country by 2022. So even though we see a little bit of short-term slowdown, as I mentioned earlier, the prospects from the second half onwards, we expect to be fairly strong. And of course, the devil lies in the details in terms of the schemes that the government actually ends up announcing. I would now like to just quickly cover Apar's financial performance. So in FY19, the consolidated revenue came in at 7,971 crores, which is 37% year-on-year above the previous year. EBITDA came in at 475 crores, which is up 15% year-on-year. And this was largely driven by better profitability from the cable business and also some improved performance on the conductor segment. We did have, as I mentioned in the last earnings call, a lot of volatility in the base oil prices, which impacted the oil division's profitability. And this we managed to recover only by the end of the year. We have seen higher interest costs due to the LIBOR rates which went up, and also higher working capital interest arising from the increased revenues. The profit after tax came in at 136 crores. If you look at specifically the fourth quarter, the consolidated revenue increased by 39% to 2,466 crores. The EBITDA increased 8% year-on-year to reach 137 crores, and the profit after tax increased 9% to close at 44 crores. I'd now like to briefly cover each of the three segments and give you some of the highlights there. In terms of the conductor division, business grew by 53% year-on-year to reach 3,915 crores in FY19. Volumes increased 10% year-on-year to reach a record 1.8 lakh metric tons, which is the highest volume that we've done. The EBITDA per metric ton post forex adjustment came in at 8,960 rupees, which is 14% higher than the previous period. The share of some of the newer businesses that we have developed, which is the copper conductors for the railways and high efficiency conductors, came in at 15% for the copper conductors and 10% for high efficiency conductors. March 2019 order book is actually 2.5 times higher than what it was at the beginning of FY18 and is at approximately 3,020 crores as we open the year. The new order intake for the year came in at 5,454 crores, which is 134% higher than what it was in the previous year. The conventional conductor market still continues to remain very competitive, and hence the company's focus on some of the newer products. New orders from railways for copper conductors crossed 1,000 crores for the year. If you look at the fourth quarter, specifically in FY19, the conductor revenues increased by 49% year-on-year to reach 1,329 crores. EBITDA per metric ton post forex adjustment increased 17% year-on-year and came in at 6,680 rupees. We had a few operational issues at our plants in Odisha in the last few months with respect to the non-availability of grid power and thereby us having to use diesel generation, and also a lack of molten metal coming in for part of the period. Now, both of these issues have since been resolved on a long-term basis, and it's not likely for them to recur in FY20 and thereafter. There was also a major slowdown in awarding of these high-efficiency conductor tenders, including for the reasons that I mentioned above. So these factors had affected our profitability. We see a much higher ordering of these HECs in FY20. In terms of the specialty oil division, the revenues reached 2,630 crores in FY19, which is up 22% year-on-year. The volume growth also has reached an all-time high of 430,000 kiloliters, which is up 11%. We've seen a steady demand from the auto industry, which is reflected in higher volumes of our auto loops. The auto loop volume is up 24% year-on-year. The industrial oil volume is up also 24% year-on-year. And the rubber process oils, which largely find their way into automotive applications, is also up 14% over the previous year. The higher value segment of automotive and industrial oils now contributes 21% to our revenues. I'm also happy to announce that Apar is the only Indian company to have supplied all the major HVDC projects with transformer oil in the last 2 years. So these include projects that have been run by Siemens, GE Alstom, and ABB. If you look at our Hamria plant, we had a 62% capacity utilization last year, and this was lower than we had envisaged, and it has been impacted by some of the regional problems so far, which is a drop in demand from some of the geographies in the GCC, especially in Saudi Arabia, as well as a reduction in offtake from some of the African countries, largely due to foreign exchange related problems. EBITDA per KL after forex adjustment came in at approximately 3,000 rupees for FY19 versus 4,400 rupees in FY18. These were mainly impacted due to the cost of base oil versus selling price and other costs, particularly in the months of January and February. The profitability was restored by March, and we expect that FY20 should be a better year. In Q4 FY19, specialty oil revenue increased by 18% year-on-year to reach 696 crores. The EBITDA per KL post forex adjustment came in at about 3,391 compared to about 5,280 rupees in Q4 FY18. Now, coming to the cable business, the cable division had a very strong growth of 51% year-on-year, with the revenues for the year coming in at 1,684 crores, with good execution in all the sub-segments. The elastomeric and E-beam cable revenues grew 35%, driven by solar, railways, and the defense sectors. The power cable revenue grew by 44%. which was largely influenced by the schemes that the government had announced. The telecom cables were up 112% last year, with some execution of BBNL and BSNL orders, but also a fairly large amount of orders that we executed of Reliance Jio. In terms of the EBITDA margin post-Forex, it came in at 11.3% versus 9.6% in the previous year. In terms of fourth quarter of FY19, the cable revenues were 51% higher and came in at 508 crores. The EBITDA post-Forex adjustment doubled to about 70 crores with an EBITDA margin of about 13.7% in the fourth quarter. So in terms of our overall picture, we feel reasonably good entering FY20 as all our three segments are firmly on transformative growth. However, based on what I mentioned earlier in the opening remarks, there is a little bit of a disruption in the order flow and execution flow as we begin the year. This may have an impact in the first half, but our expectation is that the second half will be very robust. We continue to target growth in some of these new products that we've introduced, and our 2020 vision is to try to grow the copper conductor and HEC business to about close to 35% out of the conductor revenues, have elasto and optical fiber at close to 40% in cables, and grow the auto and industrial lubricants closer to 25% from the current 21% that we have this year. Our commercial production of the copper transposed conductors used in the transformer industry has been a bit delayed, but will be commercially available by the end of this quarter. Our major focus in FY20 will also be to improve unit profitability in all the three businesses. We've seen a substantial improvement in growth and the top line, but the corresponding increase in the bottom line has not been there. Various measures have been taken to ensure that the operating performance as well as procurement is all lined up. We have seen good growth. As we correct this in FY20, we expect a slower increase in revenues for the year, but definitely a higher unit margin growth across the businesses. And finally, we expect that with the re-election of the Modi government, there is likely to be a very strong boost to infrastructure, power, and the economy in general. Already, some of the plans are in works, which is with respect to the smart metering and prepaid metering, as I discussed earlier, the transmission lines for renewable energy as part of the green grid, strengthening of the existing grid, and the railway electrification. So we are quite optimistic, but more specifics are awaited as the new policies and the schemes of Modi 2.0 government unfolds itself. So with this, I'd like to come to the end of my comments and would like to open up the floor for questions. Thank you very much.
Sure, thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Parikshit Daftari from Equitas Investment. Please go ahead.
Good afternoon, sir. Thank you for the opportunity. So you just mentioned, that there were certain grid issues with respect to conductors in the Orissa plant. And last quarter also we had mentioned that there were certain one-off impact. So if you could, tell us in detail and quantify the reason for EBITDA margins coming down. for conductor segment. That's my first question. And also, sir, you mentioned that there are certain measures we are taking to improve the operating profitability. So what I look at, sir, the EBIT margins in H2 have come to sub 3%, and our interest cost is 2%. So conductors division seems to be, just about breaking even in H2. So if you could elaborate, what is the outlook and what measures are we taking to improve on the margins in this segment?
The operations effects which were there, they were not there in Q4. They were there up to December. From April to December, we were not having the grid power in our Lapanga plant. We had to generate the power through this power diesel generator. That was one thing. And almost from June to September, we were not getting the molten metal. We had some issues with the Hindalco actually, so we were not getting the molten metal. But as far as Q4 is concerned, there were no operational issues.
So, sir, then why would what would be the key reason for our EBITDA per ton to come down?
The EBITDA per ton has come down because of the low margin orders actually. The low margin orders which were there actually. See, the different orders are having different margins actually.
Okay.
And more of these low margin orders were executed during Q4.
Okay.
Also, the high
like
efficiency conductor plays a very big role in terms of the overall profitability. And a lot of the tenders which were not awarded, etc. So the order book and execution was relatively very low in the fourth quarter. Also, some of the orders which were expected have got held up or were held up because of the model, code of conduct. Having said that, already in the last week, there's already a flow of these orders that have started coming in. So our expectation is that in FY20, some of the pent-up demand of the last year will also get covered. In addition to this, new copper orders also have come in for the railways. So considering the current order book, we see a much better average performance for FY20 compared to FY19. So
this HEC orders, the execution we expect to pick up only by H2, right? So H1 still, last call you mentioned that the tenders were open but not concluded. So
we expect the orders to actually start, the ones that have been awarded to us in the last few days, they will start getting executed from the second quarter of this year onwards. So it will be still part of H1.
Okay.
But from Q2 onwards it will start.
Okay. And so the presentation mentions that the order book for railway conductors is about 570 crores. And so what would be the execution period for this order book? And am I correct to assume that we have 225 crores of revenue contribution from railways in this quarter itself, Q4?
How much?
225 crores. So what kind of expectation we have for these railway copper conductors in this coming year, FY20?
Coming year, we should be doing close to about 950 crores of railway conductors.
Okay.
And we will be getting more orders actually. This is the order book as on 31st March.
Okay. And from the CTC conductors which we expect to launch commercially, say by the end of this quarter you mentioned, right? So in FY20, what kind of contribution can we expect?
That will be, actually there will be some loss will be there actually. We are not expecting much because although we will be launching it commercially by end of the first quarter, it requires a lot of approval from the transformer manufacturers as well as utility after the trial runs are over.
So the total capacity for the plant at current copper prices is around 360 crores for the year, which on a full year basis will be about 90 crores a quarter. But the initial period is a little uncertain in terms of capturing exactly the volume because of the approval process that's required. So transformer manufacturers, the way the process runs is that transformer manufacturers need to apply to a utility saying they want to use so-and-so company's CTC. And then the utility then does some basic diligence and approves the product. So the process has already started from the last quarter of towards the end of FY19. But we expect that, it will take about 5 to 6 months for a lot of these approvals to come in, and then there will be a ramp up. So our sense is that we'll be able to use maybe about 30-35% capacity utilization in the first year, and the second year there will be a very steep climb in terms of utilization.
Okay. And so if you could just break the, give the breakup of debt as of now, as on date, or maybe as on 31st, like the
long-term debt is about 165 crores.
Okay.
Short-term is about 88 crores.
Okay.
So total is 253 crores, and cash and cash equivalent is about 412 crores. Other than that, there are some liabilities actually, LC liabilities.
Right.
So LIBOR-based liabilities are about 1,325 crores, which are incurring LIBOR-based interest. And domestic interest liabilities are there about 941 crores.
941?
Yeah, 941 crores.
Okay. Okay, sir. Thank you, sir. I join the queue.
Thank you. Before we take the next question, a reminder to the participants, if you have a question, please press star then 1. Next question is from the line of Anuj Upadhyay from Emkay Global. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir. So just a follow-up on the previous question. You mentioned that the Lapanga or Odisha issue was over by December. We started receiving power from the grid. And also the availability of the molten metal issue got sorted out. Secondly, the copper conductor business contributed almost 17% to our revenue in the Q4, which I believe is a high margin business. And our EBITDA per metric ton post-adjustment also went up by 17%. But overall margin was down. So could you just, explain or understand how exactly is it happening? Which is the area which I am missing out here?
It all depends upon the order margins which are there. So a lot of orders got executed in this. You must have seen. We have done close to about 62,000 metric ton.
Okay, right.
Quarter actually, which is the maximum at any point of time which the conductor division has done in a quarter. So a lot of orders pent up which were there actually, they got executed in this actually. So in that, a lot of very low margin orders of conventional conductors got executed.
Okay.
These were actually older, there were orders which were taken, during this TBCB tendering and stuff earlier.
Okay.
Where, there were some amount of, losses or escalations that had happened, particularly with respect to HTGS, which is steel wires and things which are not possible to hedge in terms of, a longer delivery or longer duration. So a little bit of that came in, towards the end of the period. So it's really a composition. So in the first quarter, in the first half of the year, more profitable orders got executed. In this period, a little bit less profitable orders got executed. But looking at the current order book which we have as we enter FY20, in this business, it's better to look at it in a larger, in a full year period.
Okay.
Because, on a quarter-on-quarter basis, we don't have control in terms of the way in which execution will happen, because the call-ups happen based on the project deliveries that are required.
Right, sir.
So what we have, in terms of what is expected to be there in FY20 will be higher than what is there in FY19. So FY19 came in at almost 9,000 per ton.
Right, sir.
FY20 we expect it to be over 10,000 a ton.
Okay.
And still it has improved actually. Means FY19 is, for the whole year, is better than the FY18 in spite of the HEC orders, lower HEC orders.
Right, sir.
Overall HEC orders were only 10%, whereas in FY18 they were about 13-14%.
13-14%.
Yeah. Correct.
So, sir, could you please give breakup of the order book, like among how much would be the HEC, what would be the copper conductor and the conventional?
The HEC is about 525 crores and copper is about 575 crores. And balance is the conventional and rod.
Roughly 2,000 crores, you're saying?
3,000.
Yeah.
No, conventional is roughly 1,900 or 2,000, right?
Yes, because total is 3,020.
Fine. And so the cable segment's margin in the last quarter was somewhere around 13% plus. So would it be sustainable going ahead, sir, or it was just a one-off case, just depending upon the product mix which got executed for Q4?
Yeah, the product mix that got executed in the fourth quarter was relatively very rich. So the average margin for the year was about 11.3%. So we expect that a similar margin will be there in FY20.
20 as well.
Yeah, so it will be between 11.5% and 12% is what we are targeting.
Right, sir. And then last call you had mentioned about 350 per metric ton of benefit which we are expecting from Lapanga. So has
yes, that has got actually because of the grid power.
That was of the grid power.
So there are two benefits from the, one was that the grid power had got delayed substantially, which has now come through. And the molten metal also has an impact. And now the whole molten metal delivery system and agreements, contracts, everything is all streamlined. So we don't expect any outages on the molten metal front now in FY20. Everything's lined up.
Fair enough. And lastly, sir, what would be the capacity of our cable segment, sir? If you can provide some highlight on that part.
It's difficult to give because the mix in cables has a huge impact in terms of the quantity that's produced. Last year we did 1680 crores in revenues. This year, I mean, the capability of the plant is to do over 2200 crores if it's loaded, evenly through the year.
Right. And
on a similar mix basis.
Fine. And if may I ask one more question, sir, any growth outlook across the segments, sir, for conductor, specialty and cables?
So, to give a definitive guidance at this moment is a little tricky because we are waiting for, the announcements of the various schemes that come in from the government. And they have a material impact in terms of, especially the distribution side of the business, which is affecting the distribution type conductors as well as the cables. So I think a much better guidance will be available from our end, when we 1 quarter from today, when these schemes will be announced and the impact of that will be clear. So you'll know more clearly in terms of in which quarters bucket what revenue is likely to fall in.
Okay, but margin would be better, you are saying, across the segment compared to FY19.
Yes. Because the oil business also actually, which is where a lot of the volatility came in and hurt margins, especially in the December, January, February time frame. We already have, March has got restored and the first quarter products are already ordered, all the raw materials, etc., and most of the pricing has been set.
Okay.
So our expectation is that as we enter FY20, the oil side seems significantly demystified in terms of the margin delivery.
Fair enough. Thanks, sir. Thanks for the opportunity.
Sir, does that answer your question?
Yeah.
Thank you. Next question is from the line of Saurabh Patwa from HDFC. Please go ahead.
Good afternoon, sir. Thanks for taking my question. I hope you can hear me properly. So just wanted to understand, while we are changing a product mix in terms of copper, so this is giving a higher revenue growth, but was wanted to understand how is the working capital and ROC for this product, because if what I understand from your last calls is this has a similar margin as EBITDA per ton as HEG, but their capital employed required would be higher in this case. That's what. Can you just give some your thoughts on that?
The margins are in between the high efficiency conductor and conventional conductor. They are not having similar margins as high efficiency conductor.
Okay.
But the working capital cycle is short actually. So close to about 45 to 60 days we get our debtors actually. Whereas in case of conventional conductors, we get about 108 days actually. Debtors cycle is 108 days. Similarly, inventory is also a little bit shorter than the conventional conductors.
Okay, so that makes up
one party. Because mainly there is only one party which is there, or sometimes these EPC contractors like KEC or Kalpataru, they are there actually.
Okay.
So Saurabh, actually the introduction of a larger and larger percentage in the mix of copper is actually very beneficial to the operation, because it takes approximately the same amount of processing, but you end up getting 3 times the value. So the cost of processing goes down, and the utilization of the equipment, relatively. So if you look at the amount of sales to asset utilization also improves if you run copper. And as Mr. Devadkar said, the cycle is a sub 60-day cycle as of today, versus a 100-day cycle for the conventional conductor business.
So is this the reason why a capital employed in conductor division has come down sharply this year compared to last year?
That is one of the reasons actually.
So can you just have some light on what would be the other reason? Because it was like some 375 crores last year and has come down to like almost close to 100 crores this year.
Actually, one more reason is that actually the conductor division was buying aluminium for cable division also. Whatever aluminium rods were required by cable division, conductor division was buying these aluminium ingots, converting it to rods, and giving it to cable division. So you will see that the cable division working capital has increased and the conductor division working capital has gone down because the liabilities are sitting in conductor division.
No, actually, so actually even the cable division working, this capital employed has come down. It is what unallocable has increased. So is there some reclassification?
No, there is no reclassification. Unallocated has only the other things which are there, the head office and all these things actually.
Yeah, but that has increased very sharply this year.
Yeah.
Or should I take this offline?
Offline.
Okay. Okay. And sir, what would be our guidance on tax? Because I think this year our tax rate was pretty high compared to...
See, as I explained last time also, we are now having, in India we are having full tax rate. But our subsidiary is there actually in Hamria. So if it makes loss actually, then we don't get any tax benefit for that actually. So if it makes profit, you will feel that the tax rate has come down.
So
but
now
right now it is making loss actually.
Right now it is making loss.
Yes.
Okay sir, thanks a lot. That's it from my side. Thanks.
Next question is from the line of Vikrant Kashyap from Kedia Securities. Please go ahead.
Sir, good afternoon.
Yeah, good afternoon.
I have one question. Sir, your top line growth is really impressive, but we are seeing that net margins has come below 2%. So, in next 2 years, will we get back to around 4% margin level that we had earlier? What's your outlook on that?
Yes, so as I mentioned earlier, that one of the major focuses that we have in FY20 is to work on unit profitability or unit margin. There was a very sharp impact that had happened from the oil business, where if you take the profit that we had compared to the previous year, it's on an absolute level, it's almost half of what it was the previous year. So that itself will make a difference of a percentage point, in terms of as we restore that. Plus, there are other operational benefits which will come in, as we spoke about on the conductor side. And last year, in both in the conductor and cable, we had a lot of movement of machinery that, as we realigned our plants. So most of that has already been now completed. So we've settled everything at Lapanga and Jharsuguda and Orissa, and also the reconfiguring between the two different locations in cable has been pretty much completed.
Yeah.
So the operational benefits which we will see or had envisaged, because of which we made all these moves, we should be able to get a full year of that in FY20.
So what percent? 3-4% bottom line?
So yeah, our target is to actually get up to, so if you go more than a percentage, to cross 10,000 tons again on conductors, to get to 4,000 rupees per KL plus on our specialty oil business, and to keep the cable margin between 11.5% and 12% on an EBITDA basis. So these are the three major areas. So if we end up hitting these three, then obviously the unit profitability will be much higher. See, as a percentage, it also depends on commodity prices, but this would be the guideline which we are trying to target.
Yeah, since see that the points you made are very valid. That you went into railway conductors. We understand HEC contribution to total conductor revenue were lower. In specialty oil you get hit, but in cable segment you definitely did very well. So we understand that a year and a half was relatively not in favor of the company. We understand that. So on that, the changes you have done and the benefits of transfer of the plants and other things that you have mentioned, this has to transform into the stronger bottom line that we were expecting, and that's why we were looking for a number from you.
Yeah, so if you look at constant prices of today, it will definitely be up by 1.5% compared to compared to what it is now. This is 1.7.
Yeah,
it will definitely be above 3% at current price levels.
Yes. That's what. Thank you very much, sir, and wish you best of luck.
Yeah, thank you.
Thank you. Before we take the next question, I would like to remind participants, if you wish to ask a question, please press star then 1. Next question is from the line of Nimesh Shah from MK Investment. Please go ahead.
Yes, sir. Thanks for the opportunity. Sir, I just joined in late, so want some data points from you. So what will be the open period forex for the year?
Open period forex for the year is about 15 crores.
Okay. And so one more thing was, what is the capex plans for the next 2 years?
So we have a capacity plan of approximately 150 crores for FY20, and then FY20, meaning that's the projects which will be kicked off.
Okay.
Most of which will be executed in FY20. Some of it may spill over into FY21, and then in FY21, the three businesses, the capex will fall considerably. The oil and conductor business will just run at maintenance capex. And in the cable business, depending on the government schemes and the opportunities that are there, we may need to invest in debottlenecking and increasing some capacity.
Okay.
But FY21, I would expect sub 50 crores.
Okay.
So there will be substantial cash generation in that period.
And sir, one more thing is, we noticed that the working capital has improved quite sharply. So from say 9% of sales, it's gone down to say 3%. So is this a year-end effect, or is this something sustainable?
No, it is not a year-end effect actually. But the working capital, if you see number of days, they are more or less same actually. There is not much of an effect actually, which last time also I have said. The debtors number of days and all these things. Some improvement in inventory is there as far as cable division is concerned.
Okay.
But otherwise there is not much.
So in fact, one of the things that we've managed to do well in through the last year is to manage our working capital well. And in some instances, this management of working capital has come by not executing certain orders, not selling to certain clients where exposure limits had become high. So that as Mr. Devadkar says here, the number of days outstanding, whether it's debtors, whether it's inventory, all that has been maintained very tightly through the year.
Okay.
So in fact, that is one of the better things that we managed through, which is otherwise a pretty difficult period. And looking in FY20 also, it will have to continue this way until the current credit problems are sorted out, which may take probably at least 6 months.
Okay. I'll just hand over to Mr. Sachin.
Sir, precisely the point that this year the working capital has actually generated a lot of cash flows for us. From what we can see, that we've generated nearly 300 plus crore kind of a cash flow from this. So will this cash flow go back in the business, or do you think now that we've done this good tightening and this should actually sustain? That was precisely what we would like to understand.
There was a cash and cash equivalent also, which I said 412 crores.
Right, exactly.
So it will go back in the business.
Cash flow.
It will go back in the business actually. So it sometimes what happens actually in our case, because we deal with government directly or indirectly. So in government case actually they try to give the debtors, the payments.
At the end of the year.
At the end of the year.
So I think the better measure would be actually looking at a 5-point average in terms of
number of days, instead of looking at a snapshot number.
So we as a management try to keep a very tight track on what are 5-point averages in terms of debtors, creditors, inventory, all the key working capital ingredients that go in. So we don't see the cash may have gone up because some payments have come in and we've cleaned up some of the old receivables which were due have actually come in before the end of the year, but fundamentally there's no change in the business pattern.
Okay, that's it from us. Thank you.
Yeah, thanks.
A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. Next question is from the line of Shraddha Seth from Edelweiss. Please go ahead.
Hello, good afternoon, sir.
Yeah, good afternoon, Shraddha.
So just wanted to understand in the conductor side, we've had our order book going up substantially, almost 2.5x, with new order inflow also up almost 135%. However, in terms of execution, apart the copper conductor and railways, in the railways and the HEC side, we generally don't seem to be enthused by the, execution. So just wanted to understand this, disconnect in the order book and the pace of execution.
So the railway side, the execution has been quite steady so far, and it's been pretty much in line. The problem has really been on the high efficiency conductor side, because these are largely reconductoring projects, so they're a little bit more complex in terms of the whole awarding and the execution cycle. So we hit, I think we've hit the low point last year. This year the order book already is at 525 crores, and there's a whole lot of tenders which from last year have got postponed and not been awarded. So I think as we move into FY20, we have a much better confidence in terms of the high efficiency conductor side. It's just that once bitten, twice shy. Last year there was so much uncertainty in terms of its execution cycle. So in the next few months, there will be more clarity. We expect these orders which have come in based on the normal delivery schedules, the executions also to start in the second quarter itself of this year.
Okay. Because somewhere I think in the commentary you said, post the execution of these electrification schemes, the disbursement to the vendors has slowed down. So
in the case of high efficiency conductors specifically and a few large ticket conductor orders, even the tenders which were open and we would have thought in the normal course they should have been awarded, they were stopped from being awarded because of this model code of conduct during the election. So basically in April and until the election results were declared on the 23rd, there was no ordering that took place. In fact, one HEC order has come just a couple of days after the election results, because everything was there but they didn't want to award it during that period. So there has been that. What I was more referring to from that comment is that on the distribution side, the demand is very strongly correlated with the government electrification schemes. So the distribution transformers, some of the 11 kV cables, 11,000 volt cables, etc., are quite correlated with the schemes which were there, particularly this Saubhagya and the Deen Dayal Upadhyaya scheme. So our sense is a second version of that is coming up because the government has not completed all the work that has to be done in that area. But until the amounts are recommitted, you will not see that boost, which was seen last year in terms of volumes.
So this would impact across all the segments, would hit us across segments in the volumes?
So there will be an effect in power cables in the cable side, not on the railways, not on the E-beam side, because that goes into the railways, defense and some of the non-conventional energy, where we already carry a good order book. In the case of conductors, the effect is not very major because it's only the distribution conductors which are affected in this. And we we have a fairly good order book on the copper, HEC and the conventional conductors in terms of the total volume. In transformer oil side, you will have an effect on the distribution transformer part of the business. So you see volume slow down on the transformer oil side in the first quarter until the coffers are filled in again on these various electrification programs.
Also, in terms of HVDC, you think a lot of it has already got executed and now the pace should slow down?
See, the contracts that Siemens had and GE Alstom have pretty much been executed, but a very large portion of the ABB BHEL is still to be executed. So we see all that delivery happening actually in FY20, and the volume of that is more than what had happened in the previous period. So on the contrary, we'll see more shipments happening. Where we are seeing a little bit of a slowdown is on the 765 kV AC side.
Okay. And lastly, overall profitability, which has come down to under 7% kind of margins on a company level. What is the guidance we are talking about at the company level?
So, I think we can give a much better number, after a quarter once, all the schemes and everything are clear. What will fall in what bucket, hopefully. But our expectation is that just with all the operational things which we see clearly on the table, we should see about 1.5% improvement in the bottom line as we execute this, FY20 versus FY19. So the 1.7%, profit after tax should go up by more than 1%.
Understood. All right, great. Thank you.
Thank you. Next question is from the line of Lala Ram Singh from Vibrant Securities. Please go ahead.
May I have the order book for conductors in terms of volume, metric ton?
Order book is about 1,34,000, which is about 9 months execution.
Understood. And overall, next year, do we envisage volume growth in the conductor division?
Not much.
Not much.
We actually see a big change, or we are targeting a change in the mix, because moment high efficiency conductors come in, you have a higher value per metric ton going out, and we also see a growth happening on the copper conductor side, where you will have a higher value per ton going out. So tonnage will remain in the same ballpark, but the value per ton will go up.
Understood. And your guidance or aspiration of 10,000 rupee per ton of EBITDA incorporates the fact of this product mix change, or do you think it can be much higher than that?
And it incorporates actually.
It incorporates that. Depending on the amount of high efficiency conductor that physically gets executed in the year, you can then see an upside on that number.
And
but
can we
like a reasonably, based on the execution schedule that's available for us, this is pretty much what we should pick up in the year.
And is it possible to actually give a waterfall of EBITDA per ton across conventional, then your say copper conductor and then HEC? Is it possible to give a range?
No, we are not giving that actually.
Okay, got it. My second question is on oil division. I think our EBITDA per KL is perhaps the lowest in the last 5 years, I believe. So was this only a function of the consistent increase in the raw material prices, the base oil?
The main problem was that we were carrying very high cost inventory when the crash took place in November. And as I mentioned in the last call, maybe there was a bit of a faulty judgment at our end. When the sanctions came into Iran, we were, the oil prices were going up, and there were opportunities to buy base oil. And the idea was that you have a little bit higher level of inventory so that you can even out, price increases to your customers, match, the selling price and the base oil price. Unfortunately, what happened is that $35 is the crash that took place in a very short time. So we had this huge mismatch in terms of then what the expectation in the market was of pricing versus the inventory which we held. So it took about 2.5 months to purge all that. So December and January were 2 months which were badly affected, and part of February. From March onwards, we've now cleansed the system of anything that's expensive and out of line with respect to current market prices. So March we had normal margins, and then we expect that to continue through the first quarter.
Understood. So this financial year, we can revert back to our 4,000 plus EBITDA per KL. Is that?
That's the target.
And what could be the possible risks to this number? Again, any sharp increase in the crude oil or base oil or something else?
No, actually the risk is not when it climbs up. The problems we've had, if you see, over the last, right from 2008, onwards, where there was a big crash, the problem really takes place when there is a huge crash. Because the increases that happen, you generally, are in a position, given the pipeline of material coming in, to be able to increase the prices. When you have a $35-40 crash in the price of crude, and we do a lot of specialized products, so actually we have a slightly longer supply chain. And the refineries make special runs for us, to be able to produce the kind of products that we deliver. So when there's a very sudden fall, like what happened by about $35 a barrel, we were caught at the wrong end of that.
So generally, how much months of inventory do we keep on a steady state basis of base oil?
You'll have the inventory that we physically hold would be about 40 odd days, between 30 days and 45 days. But there is also material in the pipeline, which is coming in from the refinery to us. So if you take a complete cycle, you're looking at between 60 and 90-day cycle depending on the grade.
Understood. And does the coming IMO regulation have any impact on supply side for our category of oils?
So, there is no direct impact on our category of oils because our category of oils are very low sulfur.
Okay.
And what you're talking about, this IMO or MARPOL 2020, that is going to have a huge impact on the fuel side for ships.
Understood.
But the jury is out. Nobody knows what that impact will be because some of the low sulfur products could get diverted into blending with the fuel to bring down the sulfur levels because it's a huge jump. Currently furnace oil and bunkering fuels run at between 1500 and 3000 ppm.
Right.
And the new regulations actually bring it down for it to be below 500 ppm.
Understood.
So there's a big impact that will come on the bunkering fuel side. Now, how they are going to do that, the jury is still out, in terms of that. What I can tell you is that companies like us, which run on contracted volumes, would actually benefit relative to people who buy only on spot. Because the spot volumes where, the refineries don't have contracts on, could easily move towards reducing, sulfur levels in the bunkering fluid. When you have contracts, then, you pretty much end up delivering that. So that's, so it's actually, we run contracts to insulate ourselves, from these sort of major events and risks that are associated with them. Does that answer your question?
Yes, it does. Yes, thanks a lot. On the cable...
Sir, may I please request you to rejoin the question queue for your follow-up as we have people waiting for the turn?
Okay, I'll do that.
Thank you. Next question is from the line of Parikshit Daftari from Equities Investment. Please go ahead.
So you just mentioned about the capex plans of 150 crores for FY20. If you could just elaborate on, what are the key projects we are taking up in this year?
Okay, so if you look at our oil business, the main project is actually increasing capacity in terms of blending and packaging of our industrial and automotive products. So the capacity there will increase in a step function where, we will go to 10,000 KL a month from the current capacity of about 4,500 KL a month.
Okay.
So that constitutes, approximately, so the capex on the oil side is approximately 40 crores, which should complete the civil work and, this whole project, including a little bit of maintenance capex. So about 32-33 crores is associated with this project, and the remaining is maintenance capex. On the cable side, we have a new E-beam that's going in, a new electron beam, because we are running almost at close to capacity on the 2 electron beams that we have currently, and we see a big growth likely to happen in the cables that go into the railways, and from in 2022 you will have a lot of nuclear power getting added again in the country, and again you need these E-beam cables which go into some of these nuclear power projects. Also, these cables are finding their way into defense, and the defense consumption of cables has been steadily growing. So the cable side has a total capex of approximately between 80 and 90 crores, including around 30 odd crores which goes into the beam.
Okay.
And the conductor business has a capex of around 30 crores.
This would be for which category of conductors?
So it's, it's going in, you have the completion of the CTC project, which is taking place.
Okay.
And then there is also some debottlenecking that's happening at the plant, so that, we have got larger capacity in place for high efficiency conductors. Plus, there are some standing machines and all which we are making more fungible between copper and aluminum.
Okay.
Because, if the railway demand continues to be there over the next few years, that flexibility would help us in terms of, meeting surges on the copper side. So the whole plan is between 150 and 160 crores, which would be initiated in FY20. A little bit of that would actually roll over into FY21.
Okay. Okay. Thank you, sir.
But I think the key is that in FY21 you will see a drastic fall in the
capex.
Yeah.
Thank you. Next question is from the line of Alok Devra from Yes Securities. Please go ahead.
Hi, good afternoon, sir. So most of the questions have been answered. Just a couple of them. How much would be the optic fiber contribution in the cable revenues?
So out of the 1680 crores that we did, the fiber optic is around 250 crores.
Okay. And actually, the fiber prices have actually crashed in the recent months. So have you seen any impact on that in terms of margins or?
So for us, actually, it's good because we buy the fiber.
Yeah.
So there were periods when the fiber prices were very high. Fiber manufacturers, had an advantage of cross subsidizing fiber versus cable. Whereas today it's the reverse, where the fiber prices are at very low levels or very competitive levels. So it's actually for somebody like us, it's a great benefit.
Right. And just one more question. So automotive, this oil forms and industrial oil combined forms nearly 21% of the oil revenues. So how much contribution can we see in FY20 from those segments?
How much growth do you mean?
No, contribution to the overall revenues.
Yeah, so our target is to try to grow those revenues from 21% to 25%.
Okay. Just one last question. Actually, the oil segment EBITDA has been, under pressure because of the base oil volatility. So we are seeing volatility continuing at this point of time as well. So where can we see this number, in FY20, the oil EBITDA?
So, the current volatility that you're talking about is you're looking at oil today at $70 plus minus $5.
Right.
The problem that we are talking about is when we got, when you had crude falling from 80 to 80, almost $85 down to $50. And we had a larger amount of inventory than, we would normally carry for, as I mentioned earlier, for two reasons. One is that we were expecting, availability to tighten after the Iran sanctions. And secondly, we were entering into what is a season period for us, which is December, January, February, March. So, the current volatility is not representative of what happened, in that November time frame. There, I think, as a company, we were affected and a little bit more affected than other oil companies because we were just carrying a larger amount of inventory when, this huge drop happened.
Right. So if right now if it stays within this $5-10 range, then you are pretty okay with that.
That's not really considered as significant volatility as far as base oil is concerned.
Sure. Okay. That's all from my side. Thank you and all the best, sir.
Thank you. Reminder to the participants, if you have a question, please press star then 1. Next question is from the line of Shraddha Seth from Edelweiss. Please go ahead.
So just one question, last question on the interest cost. If you can just explain how do we look at the year ahead?
Now interest cost will not increase actually, and as a percentage to revenue, it should remain same. If the revenue also increases because of the commodity prices or something, then interest cost will increase because it is driven by value.
But we don't see any further growth taking place in terms of
rate of interest.
Yeah.
The rates of interest, the LIBOR rates or something like that, they will not increase. Even in the lower domestic market also, we are not expecting that the rates will increase. So on account of rate increase, they will not be there. But suppose the value increases because of the commodity prices or we doing more business or something like that, then some small increase may be there actually. Correct?
So 50 crore per quarter kind of a run rate, because last year we also had a lot of GST related disruptions. So so this kind of a run rate will continue.
Yes, correct. So last year's GST problems are not for the full year. For the first half, I think the GST problems were there. Later on, the GST got normalized. Now also, as of 31st March, we are having about 20 crores of refund pending. But that I feel that is reasonable actually, and that is bound to be there for our size of company. Unless the government increases its ease of doing business further.
So we don't expect a big change in the interest side because we are trying to maintain the same number of days and the interest rate should not change substantially. So the only time you'll see interest in an absolute number going up is along with the volume and along with if the commodity prices change substantially. The outlook for commodities also in FY20 is that they'll remain within a certain range, both copper, aluminum as well as crude.
Okay, because there has been good softening across the raw materials, so we still assume this kind of a run rate to continue, right?
Well, it will be pegged in with the value. So if the raw materials soften, then automatically the absolute value of interest will go down because we are trying to peg the same number of days. Keep the debtors and within the current cycle, keep the inventory within the current cycle.
Got it. All right. Great. Thanks.
Oh, thank you.
Yeah.
Thank
you.
Thanks. Next question is from the line of Ankit Gupta from Indian Nivesh. Please go ahead.
Sir, since there is a lot of volatility especially in our oil business, so do we plan to have any hedge policy or something? Will it be prudent to hedge our raw material cost or inventory as such which is in the system?
The base oils are not hedgeable because there is no hedging instrument as such, for base oils because they are a function of what happens in the crude and crude derivatives and what also happens in terms of supply and demand, from the production that refineries have. So the only way to to control that volatility is to just keep a tight cycle.
Okay.
Now in our case what happens is that because we have a lot of specialty grades which require very specific raw materials, in some cases the procurement cycle is a little bit longer. Like for example transformer oils and the oils which go into the high voltage DC transformers, HVDC, it has a over 90-day cycle in terms of it coming into us. So there is a little bit of that which is there. But as I said earlier, the volatility becomes very apparent only when there is a huge change, not crude plus minus $5. The impact we saw because we saw crude falling from the 80s down to the 50s in a span of 2 weeks.
So I can understand that there may be some quarterly fluctuations in margins, but if we look at last 4 years, it has been consistently falling. So our EBITDA per KL, which was 5,400, has been consistently falling by 400 rupees per KL in last 4 years. So is there some structural fall in the margin, or because 4 years of volatility is, or I don't know, how do you explain this?
No, so I don't know where you got your numbers from, because if you see our FY, let's take full year periods.
Okay.
So you have
open forex. This one FY16 was 5407.
So you had actually FY15 at 2700, then FY16 came in at 5400.
Right.
Then you had FY17 at 4900, FY18 at 4300, 4400.
Right.
And then FY19 is actually where we had this big impact, and it came down to about.
Here it was there. Here it was there.
We also had a similar situation in FY15, where there was again a problem that had happened. But our expectation is that our target for FY20 is to take it back to 4,000.
No, sir. So my question is...
If your question is there is a structural change in the market, the only structural change in the market that has happened is that our white oils have got largely commoditized.
Okay. That's what my question was, that is there any structural change or some product mix change? Because if we take FY16 as the starting point, then there is a linear straight line pointing downwards of margins. So from 5,400 to 4,900 to 4,500 to, let's say, 4,000 rupees also normalized EBITDA per KL. Then also there is a straight line pointing downwards. So is there a structural change in the market, or is there possibility that we will resume back to 5,000 kind of 5,500 kind of level?
5,000 was is not something which we, if you take the years prior to that, it was at 3,100, 4,800, 2,800. That 5,000 was the high that we had in that one particular year. But our target is to be able to do, if we do 4,000 and at 4.3 lakhs, it will be a it will be a good financial performance.
Absolutely, sir. Absolutely.
So that's actually what the target is. In terms of structurally, you'll see in some of our earlier earnings calls also I've been saying that our white oil business has got largely commoditized, and so as a consequence, it's not an area that we want to strategically look at. We will be opportunistic in that market. Right. Our whole focus is to grow the higher end transformer oil and to grow industrial and automotive products.
Good, sir. Thank you, sir.
Thanks.
Thank you. Well, ladies and gentlemen, that was the last question for today. I would now like to hand the floor back to the management for their closing comments. Over to you, sir.
Yeah, thank you very much for your time, and we look forward to FY20 being a better year in terms of profitability. Thank you so much.